Hello, I'm Dominic Hobson, co-founder of the Future of Finance. My guest today is Bruce Jackson, Chief Financial Officer and Chief Capital Officer for MembersCap, the Bermuda-regulated investment manager specializing in reinsurance investing, which he joined from Apex Group, where he was Chief of Digital Assets in June 2025. Bruce, thanks very much for joining us.
Thanks for inviting me, Dominic. It's a pleasure to do this with you.
Institutional money, it's reluctant, as far as we can tell, to invest in illiquid asset classes such
Mm,
as tokenized securities, tokenized funds, which gives the industry a chicken and egg problem. It's the scale which brings the liquidity, but you need the liquidity to achieve the scale.
mm.
What's the solution?
Uh, that's not a simple answer, but let's go back a second. Institutional money is already heavily invested in alternatives. Digital institutional money, so digital foundations or large digital balance sheets, uh, is uh, is reluctant to commit to investing what we call real world assets, RWA, in digital form. What's the key to it? So the key is really taking a lot of the governance of the securities world that we know of, starting with basic things like discrete custody, and merging it, even if it feels like a train crash at times, with the attributes of liquidity and 24/7 that comes with the digital world. So that's it's getting done, but we haven't had any evidence that it can scale yet. But we're fixing that.
One of the ways you're looking to fix that is by making your funds composable. Now,
Correct.
in theory, of course, these add liquidity because they enable the components of the fund to be reused, recombined into other products, which can then be traded by people very far removed
Right.
from the original investment. They can be exchanged, in fact, on traded by people even further removed from the original investment. Tell us a bit about why you think that will add liquidity to members cap funds.
Sure. So let's start composable, and the definition I'm going to use is a fund that's composable is acceptable as collateral in a DeFi protocol, DeFi platform like Morpho, Aave, whomever. Being composable just means that they will allow you as collateral in their DeFi private lending platform, where people borrow and lend, grab a spread, loop it, create all these incredible returns. So why we're doing that? So we're doing that, and let's the layers of how we're doing that. First and foremost, if our core uh, product, our highest returning product, is a fully underwritten fund where we are writing reinsurance contracts, industry loss warrants, retro reinsurance, and we're delivering after all fees, after everything, an 11% return that's uncorrelated with equities, fixed income, crypto, and is has a 1 year duration. So in the traditional world, we're short duration, uncorrelated, and we have a risk remote strategy, which means there's 1.5 to 2% probability that any one of our investments will get hit. So in the traditional world, we're very, very much a mainstay of every institutional balance sheet out there, whether it be a pension fund or a large family or a large endowment. They all have between 1 to 5% in, not all. The biggest ones have 1 to 5% in reinsurance investments. But let's talk about where the world is going. And so we want to get that same low risk, higher yielding, low duration product into wealth management accounts, wealth management wallets, individual accounts, or smaller institutions. And to us, the blockchain infrastructure that we have created to get our product into that world is a delivery mechanism. We're not doing it in and of itself. Um, we don't necessarily have a desire to have, 24/7 trading of our product, but in order to be accepted in that world, we have to be composable. It has to. So what does it mean? So we've created, so our MCM Fund 2, our second fund at MembersCap, is invested entirely in cat bonds. So that basic underlying fund, you can buy, and it has monthly redemption, weekly subscription. It pays you quarterly income, and its expected yield, the way we're tracking right now, is probably about 8.3% after all fees versus 11 for a fully underwritten, less liquid. We have a monthly liquid fund, but to be composable, meaning that for a digital hedge fund or whoever the users are of these platforms like Aave and Morpho, for them to actually go on there, we have to have an underlying product that is T plus 10 seconds liquidity, 24/7. Someone wants to sell it on Saturday morning, they sell it on Saturday morning. Where they sell it will be wherever they have their digital wallet or one of the digital wallets. How do we get there? So how do we get from a relatively liquid alternative fund? I say relative compared to private credit or private equity, or not relative compared to hedge funds. They're more liquid, although they tend to get you. Take a monthly, how do we get that down to daily liquidity? So what happens is we work with, in this case, regulated service providers who may be regulated by VARA in the UAE, or they may be, actually regulated in Luxembourg as a digital asset service provider, or in Germany under BaFin. What we get is an entity that takes our fund, puts it in a vault, and the vault is just a digital fund structure, right? Puts it in a vault, and also in that vault is a liquidity sleeve, and in that vault, that special purpose vehicle issues the tokens. An individual or hedge fund, whomever, can purchase that token, and it will be accepted. The goal is that it's accepted as collateral on a DeFi lending platform. So they can theoretically go into that platform, and they can probably borrow anywhere from 4.5 to 6% against good collateral. We're hoping that our fund is good collateral. And if we're producing an 8-9% yield, then they've got a 350 to 400 basis points spread. And what they do with it is up to them. Now, what they're doing with it is looping it. They're leveraging it. They're taking it into other platforms and investing, taking the collateral out, reinvesting. It's called looping. But let's go back to us. So we have a monthly liquidity fund. In working with service providers, we have now put it into a vault where it's the collateral in the vault, and they're issuing a token, and that token is liquid. So what we've done is transition. And by the way, that the vault from our point of view has a custodian, just as our underlying fund has a collateral custodian. We use Northern Trust. The one we're looking at will be using Standard Chartered. But the digital asset custody, that's just where your keys are kept that access the token. So once our fund units are in that vault, and we have done AML KYC on the vault issuer, the manager, the entity that's doing that, whether it be Anemoy Centrifuge or Midas, or it could be KO in the Middle East. There's lots of these entities that are regulated entities. They're then, through their structure, able to sell these tokenized units, and these are full legal pass-through to us. These are not just mirrored tokens. They can pass them through to buyers of tokens in what we would call a KYC light process, meaning I wouldn't want to tell my regulator that each individual buyer of these tokens has passed the same level of AML KYC that our customers do. So that's where the transition happens, Dominic. We're using regulated environments that allow us to take our regulated fund product, put it in a structure, a vault that is, a custodial vault, but then the vault issuer manager can issue tokens representing our product, legally representing it, but they can sell it into a decentralized environment, so that and who are the buyers of these products? Oh, the buyers of, if you look at in the RWA token, or it's called a real world asset that has been tokenized, put into one of these things. We have good products that have come through from Apollo, from Hamilton Lane, from Fasanara. They are put into end customers who can then hold it in their wallet. It's now in a decentralized environment. So it has passed out of, from the customer's point of view, it's passed out of regulated conventional custody. They have digital asset custody, which means they control the key to access their holding. So come back, what have we really done here, Dominic? What we've really done is we don't necessarily know if the end buyer of these products is our target customer, because those end buyers are yield farmers quite often. They're specialty hedge funds and they're large individuals. What we really want is to have gone through this process. We take a relatively liquid in the real world fund, made it more liquid through regulated entities that can help us restructure it. But then it is now acceptable to an institutional digital buyer, like a digital foundation, like for Sky or for Cardano or Solana or whomever. They can now hold it on their balance sheet and pass all of their risk and screening tests and all their needs for liquidity, all their funding requirements. It can even be put in a sense into a balance sheet that might even use Basel III as its benchmark for liquidity compliance. So the point is, our end goal is not necessarily to have the MCM Fund 2 liquid reinsurance income fund distributed broadly in decentralized wallets. It will be, but our goal was to go through that process to get the liquidity that comes as a result of that, so it can be held in an digital institutional balance sheet, or it can be held in the digital accounts in Dubai managed by Standard Chartered, which is a very governance-oriented regulated entity, but they happen to have the capability in that environment of their customers having a hybrid account that holds their conventional and their digital assets in the same place. So the commonality through all this is custody is associated with regulated securities. And we start with a custody underlying fund. We put it into a vault that has yet again another custodian, but then it's ended up being passed into wallets that at the end of the day are not custodied by our regulated security standards, if that makes sense. So that's a key part, is understanding custody, understanding the difference between conventional custody, digital asset custody, and what really are the measures of acceptable custody. Because at the end of the day, my test is sitting at a table across from my key business partners, Hanover Re, Munich Re, Swiss Re, two large Lloyd syndicates, BNY Mellon, Northern Trust, and telling them we have created a liquid version of the same fund that you have been involved with helping us construct. They just want to make sure there's never any embarrassment going down the path. And we're living in a world, this DeFi world, that is very, it's incredibly creative. Like, things change in a week, and so it's fascinating. But our goal is to achieve the liquidity so that we can more broadly provide access to the 8 or 9% uncorrelated yield that we are generating for pension funds. We want to offer the same thing to your account. And we're doing it using a realm of technologies all based on the immediacy, the T+10 second attributes of blockchain.
Okay, that's quite a complicated structure, but if we go back to your original objective here, which is to create liquidity. So you're putting these fund units into a vault in the various domiciles where your fund is registered for distribution,
Right.
and then tokens are issued out of that vault. My first question is, how do you refer to service providers? How do you find those service providers? And you're talking here of custodians, of digital asset custodians who are actually capable of doing what you want them to do, which is keep a digital asset on a blockchain in a safe place and then
Yeah.
issue units. How do you find them and how do you choose them? What qualities do you look for in those
Mm.
custodial service providers?
Yeah. So it's kind of like how do you hire a good employee, right? You look for somebody who has really high integrity and that they have proven that they can do what you need them to do and that they can show the evidence of where they've done it before. They've got a pattern, they've got a history. It's like if I'm uh, the chair of a pension foundation, I'm hiring managers. I've got a whole process to go through to enumerate them, their track record, their process, their people, their turnover, yada, yada, all these things. It's no different. And we put service providers through the same grist mill. Um, let's take an example, because quite often, if you're dealing with the end foundation, the way we're doing it, we're going through entities that are providing analytic risk assessment governance layer anyway. For example, we're involved in an RFP for a large balance sheet that underpins Sky, which is the MakerDAO, the old MakerDAO DAI coin, which is now I shouldn't get this wrong, USDS. It's an $18 billion balance sheet, and this curator called Keel, who is really staffed with very, very experienced securities experts that are given $2.5 billion allocated on behalf of this stablecoin balance sheet, and liquidity really matters to them. Then they, in turn, have brought in an expert to manage the RFP, a firm called Particula. Particula are about as close as you're going to find to an institutional intermediary. When I started building my business 30 years ago, we were dealing with Mercer's or Towers Perrin or whomever. So we're going through these walls, these blockers. So we have to provide the same amount of data on us, but we do the same reverse on them. So if we decide that we are going to use, in this case, a firm called Midas, or we're going to use Control Alt, or we're going to use Centrifuge, well, we actually use Particula to make sure that, look, we've been doing this for a long time. I think I understand the blockchain world as well as a lot of people who come from a TradFi background. But they basically are giving us a report back on the technological capabilities and robustness, do what they say they can do. Did they pass the audits? Is the code actually sensible? Who have they done it for? What have been the results? Where were the problems? Where's the weak points? We do full due diligence on these service providers. Whether we're doing it in a conventional world or a digital world, we use my old firm, Apex Group, still as our administrator. They're as form forward in terms of understanding the digital asset world as any administrator out there. So it's a good starting point. And by the way, so I was there until June, but I've been, on the board of my current firm, MembersCap, for 2.5 years. So I was very involved in structuring it. And all the service providers we use, custodians, administrators, and the technological service providers that help construct the vault and all these things, we do full due diligence on them. And we pay people just as we pay Verisk to help us assess the risk of the individual investments we're making into reinsurance. We pay them hard dollars to double check that what they say they can do and the governance they say they can pass and the risk controls they say they have, we verify that. So it's not a simple process. It's timely, time consuming. It costs you money, but we're not building a small firm. We're trying to build a large one.
Mhm. And how are the investors you're trying to reach through this structure? How do they assess the custodial arrangements? Are they using old-fashioned measures like who regulates this entity? What's its reputation? Who does it work for? How big is it?
Yeah.
Who its existing client? What are the security measures it has? Or are they using different criteria to assess digital asset custody themselves?
Well, they have already assessed it themselves. So they have large balance sheets already, and they hold some assets off chain. The majority will be on chain, but they do have some assets off chain already. So they probably already have custodial relationships. Like if they are holding cash or treasuries off chain, they probably already have them with a Schedule A bank somewhere. So they've already done that bit. Although it's difficult if they're structured as a DAO for them to open the account, but that can be done. Um, they go through the process of assessing us and our risk. There's the risk of all the connectivities we have of the service providers, how they enter into our ecosystem. Because as we know in the digital world, the risk quite often is at the bridges, it's at the connections. That's where things can go wrong. So they do full due diligence. They hire a curator. The curator hires a specialist firm to manage the assessment of the risk. We assess it from our side. So it's like two people auditing each other from across the table. Very much so. But at the end of the day, it's crazy because you've created this product. It's now composable. So technically our fund, we could we could list it on Morpho or Aave, one of the DeFi lending platforms. But at the end of the day, the buyers in that environment, they're very short term, but very focused on the metrics. They want, okay, here's my yield, here's my cost to borrow, here's the max drawdown. Simple formula, 1/1 minus my drawdown means, oh, here's my vol. And based on that, I have to have 80% loan to value as to be on this platform. Okay, does the customer see their ability to buy this product at 80% loan to value and put it into other looping strategies, other ways that they can lever it and turn it? Because they want to take, let's be frank, they want to take our 8 or 9% yield and turn it into 15. That's what that buyer is doing. They're not necessarily our focus, right? We think of them as yield farmers, very legitimate, a lot of hedge funds doing that. We're not doing this because we want them as our main customer base. We're doing this because we want to achieve the liquidity that enables them to say, hey, this is a composable product. But then we want to deal with distributors of digital product, like Swiss private banks like Signum or Amina or Arab Bank or Meraki Bauman or Arca Innovations or these other firms that distribute digital product, institutional quality underlying real world asset-based product to be held on digital balance sheets. Because in the last week we've seen Morgan Stanley have announced that they're embracing digital architecture for their basic wealth management. So at some point, Morgan Stanley accounts are going to have to hold the various investments that they think are prudent in building a multi-asset investment platform, and they want to hold it in digital form. We can't stop it. It's started already. This is where it's going. And keep in mind, Morgan Stanley, that's where Cambridge Associates came from. And if you're a conventional institutional money manager, as I was, Cambridge Associates are the ultimate gauntlet you got to pass through if you want to get allocation. So, sorry, another long answer. I apologize, but it's a constant due diligence on each other.
This all sounds very, I was about to use the word progressive, but I really want to ask to what extent you feel you're really pioneering in this area. And one way to measure that is to ask yourself, let's imagine you were an old-fashioned mutual fund investment manager issuing a fund 20 years ago, and you appointed a custodian with a fund administration arm and a transfer agency capability. And so what that custodian bank would be doing, and indeed it's what 70 trillion in mutual fund assets are probably looked after in this way all over the world today. The custodian is supporting the subscriptions and the redemptions. It's calculating the net asset value of the fund every day. It's keeping a register of who the investors are. How much of that old-fashioned structure is still relevant? If you're bringing a traditional custodian to a fund manager mindset to trying to sell funds to digital balance sheets, how
Yeah.
much of your mindset do you need to throw away? How much are you really inventing this as you go along, having to invent it?
Um, so I don't think we want to take credit for inventing anything. I think that we do uh, spend a lot of time understanding, asking questions, and really looking at things from a pretty hard-ass diligence risk management approach. And let's talk about the mutual fund industry, and I'll tell you why this is working out. So, my firm, for example, there are good firms out there that you can, invest $150,000, not a retail investment, but $150,000 into a strategy not unlike ours. Neuberger Berman, Pillar Capital. I think Schroders has a decent product. Um, but it's this much in terms of where it can be. So let's compare that to mutual fund world. So, mutual funds, you can build a good balanced portfolio using mutual funds, but you're paying probably 2% fee across the board, 200 basis points. Um, what really is spurring this on, and let's take the most liquid asset class there is, repos. So we know that Morgan Stanley and not Morgan Stanley, sorry, JP Morgan and Goldman basically have been settling repos on blockchain for about 4 years, probably longer. I don't work there. And I'm told with a high level of confidence that they have improved the settlement process and the settlement cost 75, 80%. Okay, so what are we trying to do? And I'll take a line from one of the real, I think, groundbreakers in the digital asset world, Victor Young over at Hamilton Lane, who says this: we're building it bigger, better, faster. That's all. We want to get our product into your individual account, and we want to eliminate as much of um, the drag as possible. So if there's any fees being paid, you're actually paying somebody to make investment decisions. So if a mutual fund has 200 basis points, let's say a third of that went for administration, a third went for um, uh, management fee, and a third went for distribution costs. And the question is our product, or is a private credit, or a hedge fund product, or a uh, uh, infrastructure investment fund, or private equity fund, is it available to that same customer? Well, no, it's not. You can create a wrapper and a fund of funds or a feeder fund to get into these things. But by the time it gets into your own personal account, Dominic, you're paying 4 or 5%, which is just ridiculous. And, you know, our goal is that that end client, I think of my own kids, they should have a portfolio of alternative assets. They should own reinsurance because it is an incredible risk diversifier within your portfolio, and they should be paying less in total fees than they're paying for a mutual fund. We can do that if we accept that blockchain is a ledger, if we accept that all of these administration, custodial, onboarding, all of these processes and capabilities, and all the aspects of distribution can get that product into their wallet. Everybody is still getting paid, but they're still getting a much, much higher net return because of the technology. Now, in order to get everybody comfortable with the technology, primarily the regulators, which we do, it takes time. It takes proving it, doing it under duress, everything. But the why is because we, meaning that, if you have an account at Morgan Stanley, for example, right, you probably have your equities and maybe your core fixed income exposure through ETFs. So it's very low fee. And the fee you're paying them is probably for their understanding of your situation, how they balance your overall asset mix to meet your funding requirements in your long term. That is what you're paying for. The individual products become commodities. So, tokenization automates this. It you know, we want, our goal is just to think of the kind of alpha that we generate, and that go into individual accounts. And through this technology, we're just making it accessible. We're making it accessible and a higher net return by eliminating a lot of the costs of settlement and distribution and onboarding. So that's where we're going. That's where all the banks are all in on this, whether they publicly all admit it or not. We think of it as an asset manager that is very, 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 and you asked it earlier, yeah, we spend a lot of time understanding the digital asset world because we don't think it's a maybe. We know that's where it's growing. We know that understanding enables us to grow. I'm not sure if I actually answered your question, but I kind of circled it.
It does answer the question. I have one final question for you, Bruce, and it's this. Ever since I first started looking at cryptocurrency and tokenized assets, and it's getting on for 10 years ago now, whenever I speak to end investors or indeed to intermediaries such as fund administrators, they both confirm that the end investor wants to retain as much as possible of the holding structure, the custody structure, if you like, which they have got used to over the years. They like having a custodian who will make them whole
Mhm.
and will look after their assets. That's where they keep their accounts, it's where they keep their stuff. And these digital assets are not going to be any different in their minds from that. So my question is, to what extent do the traditional global custodian banks, and you've mentioned that you're working with some of them, in their historic role as custodians, as transfer agents, as fund accountants, to what extent are they ready, not just for new alternative asset classes like reinsurance income, but
Mm.
how ready are they for the way that digital assets have to be safe kept, what types of institutions they're going to have to interact with, something like yield farmers.
Mhm.
How good are they, not just at adapting to these needs themselves, but how good are they at actually educating their end investor clients?
Oh,
This is safe for you to do. We will
yeah,
look
yeah, yeah,
after you.
yeah. How good are they at educating? Let me hold that for a second. Most major banks that any of us deal with, and the largest ones, I know for a fact that JP Morgan, Citibank, BBVA, UBS, Standard Chartered, they're already there. You know, today, if they chose to unveil it, you and I could have a Citibank account and we could just send each other funds at T plus 10 seconds while we're talking. They have that technology already. Two issues. Implementing that kind of radical platform in a large bank. There are all kinds of technological integration, automation, internal issues, operation processes, staffing, all these things. It's complicated. They have to get it. But you hit on the main point. Those banks are truly custodians. They're the most respected custodians. And so, they and the Swiss banks, that's their model. They're custodians first, lending and all the other things they do on top of that. They are going to own the space. Um, how do they train their own staff? Um, Difficult. It's going to take a long time. How do they change the expectations? But then how do they explain it to their clients? Well, how about this? How about if this is done properly, that the end client doesn't have to be sold on the fact that your data is existing on chain, or that your backbone of the bank you're dealing with now has a 0% fail rate on transfers because they're all done using blockchain oracles. How about if the end customer doesn't necessarily have to be sold? They just know that they're dealing with a bank that is secure and that their funds are in discrete custody and they can't be taken, and that I can transfer money instantaneously like a Revolut. I can exchange currencies at wholesale rates, even my $10,000 account. I think that the end customer is just going to see the value attributes of what they've created. Maybe they don't have to sell the customer on that. Maybe they don't have to say, we're doing all this using blockchain infrastructure. Trust us. By the time they're doing it, they're just going to be delivering, I think, a better service. Faster, more cost efficient. As a bank customer, wherever I am, my cards will work. I can tap I can be in Prague and I can tap in local currency. I can send my daughter money because she's out with her friends instantaneously. That level of service and value that they're providing to their customers, I think, will be what they're selling. Maybe they don't have to, at that point, tell them what the book of record is, what the infrastructure is that's delivering that. What the overall architecture is of the bank that enables them to provide that service. They're just providing it. So maybe I'm an optimist. I think that's how it rolls out.
We could doubtless talk about this for several hours more, Bruce, but I think our time is up and we will have to leave it there. So thank you, Bruce Jackson, Chief Financial Officer and Chief Capital Officer at MembersCap, for taking the time to share your experiences with the members of Futures of Finance.
Thank you very much. It's a real pleasure, Dominic. Anytime.